Hello and welcome to Chart Talk from JAG Capital Management. Chart Talk is a periodic look at financial markets and economic developments using charts that make a point. Our goal is to give you timely, quick hits in a world where information overload is a daily challenge. I'm Mike Buck, an analyst at JAG Capital, and I'll be your Chart Talk host. In this installment, we're going to focus on the performance of the sector spiders relative to the S&P 500. Let's flip some charts. Okay, so our first slide shows the relative performance charts for 6 of the 11 sector spiders versus SPY, the S&P 500 ETF. Each chart plots the ratio of the sector ETF price to SPY over time. When the line is rising, that sector is outperforming the broad market. When it's falling, it's underperforming. The standout here is clearly XLK in the upper left, the technology sector. That line has been motoring higher and is now at levels we haven't seen since the dot-com peak in early 2000. None of the other 5 charts on this page show anything close to that kind of consistent outperformance. XLC, the communications services sector, rallied nicely off the lows in late 2022, but has fallen back in recent months. Consumer discretionary made a relative strength high in late 2021, but has been making lower lows and lower highs ever since. Industrials rally sharply from time to time, but overall has been choppy in a wide range. Utilities and materials made their all-time high relative strength highs in 2008 and have been working lower ever since. On our next slide, the remaining 5 sectors, along with the equal-weighted S&P 500, look even weaker, with the possible exception of energy, than the sectors on the first slide. The consumer staples, healthcare, financials, and real estate sectors, along with the equal-weight S&P 500, have all made or are close to making all-time relative strength lows versus the S&P 500. Energy is performing somewhat better, but so far relative outperformance has been followed by pullbacks. On slide 4, we focus on sector performance across 3 recent intervals. There was what turned out to be a multi-month inflection point on October 29th of 2025. On that day, the tech sector, XLK, made an all-time relative strength high versus the S&P 500, while a few days later, XLP, consumer staples, and XLB, materials, both made roughly 24-year relative strength lows. The stage was set for at least a temporary reversal in fortunes. Between 10/29 and 3/30/2026, the tech sector fell 15.9%, versus a decline of 7.5% for the S&P 500. Energy was the big winner over this interval, gaining almost 43%. Gains for materials and staples were more modest, but both beat the index. That period ended with another significant inflection point on 3/30/2026. XLK bottomed on 3/30 and embarked on a strong rally that continues to this day. The other sectors, except for energy and utilities, have also rallied since 3/30. But despite posting positive returns, they have all trailed the index, losing relative strength in the process. Energy remains the big winner over the entire interval from 10/29 to 5/15 on the strength of its 43% gain during the tech drawdown phase of this cycle. On slide 5, we drill down to the individual stock level and look at the top 35 performers in the S&P 500 across those same 3 intervals. During the tech drawdown, 15 of the top 35 names were energy stocks. Following the inflection on March 30th, there was a complete reversal in the top 35 list, with 25 of the best gainers coming from the tech sector, while energy got shut out. 6 tech names, led by Intel, have more than doubled over the past 6 weeks. It's also interesting to note that none of the Mag 7 names are on any of these top 35 lists. What's been driving tech's outsized gains? We try to provide at least a partial answer with data on slide 6, where we have forward PE ratios, forward EPS growth estimates, and PEG ratios for each sector. As of 5/15, analysts estimate that tech sector's EPS could grow 35.8% over the next 12 months, up from an estimated gain of 22.5% last October. Slide 7 shows the estimated earnings growth for the tech sector since early 2000. The current estimate of 35.8% is the highest on record for the sector, even exceeding the estimates from the tech boom era at the turn of the century. Flipping back to the table on slide 6, the big jump in tech's estimated earnings growth has allowed its forward PE multiple to contract from over 31 times to 25.3 times, despite a price gain of 16.2%. The PEG ratio compares the PE ratio to earnings growth providing greater insight into valuations than the PE ratio alone. Many analysts say PEG ratios below 1.0 generally indicate reasonable or even undervalued securities. With that rule of thumb in mind, tech with a current PEG ratio of 0.71 looks relatively cheap. Two other sectors, materials and energy, also have sub 1.0 PEG ratios. Ironically, consumer staples, a sector generally viewed as a haven during volatile markets, has the highest PEG at 3.73. While tech has had its periodic pullbacks, the sector has consistently rebounded and moved on to new highs. If it can continue to generate robust earnings growth, there's a good chance the outperformance continues. That wraps up this installment of Chart Talk. Thanks for watching.